John Sherwood, thanks for coming on, man. That's kind of an unfortunate occasion to be talking, but we discussed maybe getting on and talking about the situation because it is such a gigantic event in the market. We're talking specifically about WiggleCRC going into insolvency. I think it was last Thursday when that happened, or even Friday, I think it was. So as we discussed, the situation that we know of right now was Signa Sports United, which is a conglomerate of e-com brands, specifically sports related, had some funding that didn't arrive, 150 million euros that didn't arrive to keep it running from its holding, from its owner, which was a surprise. And so there seems to be a back and forth between the ownership and the Signa Sports United, which owns Wiggle and many other, I think 80 brands, 80 online shops. So I think maybe today we can talk a little bit about the insolvency administration, the insolvency which was I think, I don't know the legal term, but was filed late last week by WiggleCRC, which is the biggest online cycling tailor in the world. So that's what we know up until now. You know, you have worked in this business for a long time, a lot longer than me. I guess wow is the word that comes to mind. Really unfortunate. So I don't know. We wanted to get on just to kind of talk through it real quick, give kind of a service to our listeners, people that are into the business, so we can just kind of talk through it. I always say this to anybody that asks me, you're the smartest. One of the smartest people in cycling that I know. So I'm excited to at least be able to talk through some of this and see if we can kind of make sense of it to the audience.
Sure. And, I've seen, there's a lot of talk about it, loads of platforms that I didn't even think would be, and sort of channels that I didn't even think would be kind of latching onto this news have latched onto it and started to talk about it. And it's definitely a big deal, right? In our industry, for a player as big as Signa Group to get into this position is pretty bleak. And, I think there's a lot of learnings that would hopefully come out of it. And, I think it's evolving daily in terms of a story, but it sounds like they might make it through, actually, with a potential acquisition by somebody else. I know Fraser's group is having a look around there and a few other people. So, I think there is hope that certainly certain fascias within the group, like Wiggle and CRC, can make it through. And I think what's also of particular interest to me is the house brands, because they had some really compelling house brands like Nuke Proof and Vitus and DHB, and what happens to them, because I think historically we've all recognized those house brands as being part of Wiggle Chain Reaction, but in reality now they're actually part of Signa Group. So would a potential acquisition of Chain Reaction even mean an acquisition
would
of
that
Nuke
IP,
Proof or Vitus?
those brands would be removed, but potentially from the Wiggle? We don't know.
We don't know, and I think there's a lot of moving parts here, basically beyond just the fascia, which is WiggleCRC.
So is WiggleCRC, do they own Chain Reaction, or is Chain Reaction separate? Do you know?
It's basically the fact that's referred to as WiggleCRC is that it's one entity, I guess, as a trading group. Over the years, they were, of course, very separate businesses. They came together through mergers and acquisitions of the past. They used to have the office in Ireland and the office down in Portsmouth, but and those kind of ran somewhat independently. There was a period of time where sort of hard goods was out of Ireland and soft goods was kind of out of the historic Wiggle office. But ultimately, they are intertwined. They are intertwined. So I think that what resulted in this specifically is pretty well documented, and that the credit line from Signa to WiggleCRC and the group was removed. I don't know the specifics of it. I mean, recently they've become a publicly traded company, and anyone who wants to kind of dive into their books can do that quite easily. It's public knowledge, given that they're a publicly traded company. I have not done that, just to be clear, but broadly speaking, those credit lines, they work on a drawdown, right? So your credit provider says to you, hey, here's a sum of money based on a bunch of certain parameters. You can draw down on this, almost like an overdraft. Yep. And it sounds like they'd drawn down a portion of that, and they were intending to draw down on that as and when was needed.
Right.
And based on the availability of those funds, they were a going concern, right? That was obviously pulled, brought into question the going concern, and therefore they've ended up in some trouble. So yeah, that's pretty well documented. I think for me, the specifics of that aren't actually the real issue, though. That's a specific around their own funding structure. And I think the real question is, how did they get in a position where that credit line was deemed no longer a responsible investment by the credit provider, and what led to that?
Pretty big and strong message right there.
Sure. And I don't know. I certainly cannot speak with authority to the quality of leadership there or the decision making behind the business. That's their business. I know nothing about it. But what I think it does speak to with quite a lot of clarity is the state of cycling in general, and quite frankly, outdoor activities and sports. You know, one way or another, the health of our industry in general brought into question whether that credit line was
right.
was viable, and the decision was no. And you know, we've spoken about this before, but I think that whole period through COVID, which ultimately, from my perspective, was a period of unconstrained demand, led to and resulted in unconstrained decision making in certain places. And this is not specific to WiggleCRC at all. This is a generalization. But you saw unconstrained order books, you saw unconstrained purchasing, you saw unconstrained investment, you saw unconstrained growth and overhead to try and feed that. And, you know, as we all know, it's a different place today in a very short space of time. Demand dropped off, global inflation's gone up, cost of living's gone up, people's ability to purchase has disappeared. Largely speaking, people are back to work, and you know, furlough and the ability to participate in these activities has been curbed. And I think what we're really seeing now is the results of the decisions made over that period. And when demand appeared to be unconstrained, who made what decisions over that period, and what does that mean for them now? And I think, you know, hindsight's a wonderful thing. And
it's easy to look back.
Yeah, totally. But you know, it actually, in many ways, there's a lot of complexities in how we got here, but the result is very straightforward, right? It's cash flow, it's overhead. Do you still have ongoing business that can support that?
Yeah, it's a pretty simple equation at the end of the day. But I think, like you said, John, I always love talking to you. I really do, because you put a really nice, you know, the way that you look at things is I've always been really excited about. But you're saying, I want to step back and look at a couple things here. First of all, today is October 30th at 11 a.m. Central European time, in case, you know, because this thing's developing really fast. I just wanted to make sure that, but yeah, like, so the funding group stopped the investment, which anyone that works in any sort of like finance situation knows that, you know, you do have to burn cash at times to make business work. But then there's times where you think, okay, investing is not my how can I say this, like, I'm not seeing the bottom, and so, you know, I think what I put in, I'm not going to get back out, and I think, and I know you're not making that statement, I know that you're, you know, but that's what, when someone pulls the funding, typically that's the thinking around it.
Well, also dynamics change, right? And once again, I don't want to speak too specifically about Wiggle Signal, although I think this is relevant. Yeah, but what's something which I think a lot of businesses are facing in outdoor and cycling right now is a lot of funding or debt they might have taken on was to fund growth, right? And a lot of that was around purchasing inventory. Now, depending on the financial instruments that a business is using to keep itself going, a lot of that debt is sometimes secured against the inventory itself. So you're saying to your investor or your bank or whoever it is, whatever, I got $10 million worth of stock in the warehouse, right? I need some. It's worth $10 million all day long. The market's going really well. You know, give us some extra money to get some more, whatever it is. Salespeople on the road, some more space in the warehouse, whatever it is, and they're taking on debt to do these things. Then the market cools, right? That stock in the shed isn't worth $10 million anymore, right? Why is that? Well, because it's been sitting there for a long time. A lot of it's old. A bright orange jersey might have been in fashion last season. It's not in fashion this season. So that jersey itself is now going to have to be sold at a discount. That means the value of your stock is decreasing every single day. And when that happens, not just to a single business, but to all businesses, they then have to discount even further, because there's loads of people now sitting out there with orange jerseys that were last year's fashion statement and are now really out of fashion. So you've got the discounting, which drives down the value of your inventory. You've got the age of your inventory, which drives it down even further. You've got a slow market, which means you have to promote it even harder. Once again, the value drops. So it's not just that a lender might be saying, oh, well, I don't like the way this business has been managed, or,
No, it's
I don't see...
It's a macroeconomic.
It's like, actually, these people, use the financial instrument that included the value of their stock. Their stock is now worth half of what it was, and that alone means that they won't realize a return. So
that's because
it's super easy for us just to think about
of the inherent discounting that's going to happen to sell through it.
Yeah, and it's self-fulfilling, right? Yeah, because I used the term when we last spoke of holding your breath. Like, depending how you're funded and depending how much cash you have in the bank as a brand or a business or a distributor or a retailer, you could say, no, I need to realize the full margin on all my stock. I'm not going to get into the bun fight. I'm not going to sell it. But then you have to ask yourself, okay, two things. One, do you have the cash reserves to keep paying the bills?
Right.
While you wait for the salt to blow over?
Because that's cash is stuck inside your warehouse. You can't touch
Correct.
it.
And
you would normally need to operate.
Exactly. Exactly. So if you've got the approach that you want to realize the full value of your inventory, therefore you're not going to promote it, therefore you're going to hold your breath, move through that inventory incredibly slowly, but realize the full potential of it, that's an option. But then you have to ask yourself, how long will that take? Because if the market continues to be distressed for 12, 18, 24 months longer, is that stock even going to be relevant when this blows over?
So
right? If you've got a model year
every day
bike,
that goes by, that stock is worth less and less.
Correct. And once again, if you are a business that has financial instruments supporting you that are based on the value of your inventory or your stock holding, that value is decreasing. It's like having a mortgage and the value of your house becoming less and less and less every single month, right? Eventually the bank's going to say, hang on a minute, this doesn't make sense anymore. It's exactly the same thing. So that, I think, right now is one of the major dynamics in the market, is there's so much inventory. Everyone's cash is tied up in inventory, and that inventory is becoming less and less valuable.
Okay. I get it. So I guess we dove right into, like you dove right into the very, very deep specifics about potentially how this is playing out. And I know, like, we got here. I think we just need to do the people a service and just say very quickly how we got here. I know that it's probably very obvious for most people that are listening, but I think we should at least. So COVID hits, people buy too much. People buy the adequate amount during COVID because of the gigantic spike in demand. This happened across the market, so everybody wanted to cash in. I honestly think that probably bigger publicly traded companies like Signa had more pressure because, I think about what the boardroom looked like in, April of 21 when they're like, so we're showing a 40% increase of growth, so we're going to have to sustain this till next year. So did you guys put the orders in to continue to grow at 40%? And if you do that, it's like if you don't, if that growth doesn't continue, you've made those obligations. And I don't know, maybe I'm simplifying it too much, but I feel like that is maybe, and that wasn't only legal, that wasn't only Signa that was doing that. I'm sure Cannondale was doing that. Pawn was doing that. I'm sure a lot of brands were doing that because to be able to take advantage of the type of growth that we saw in 20 and 21, you have to order it.
Yes, for sure. I think there's two parts to that statement. The first one is, you said everyone ordered what they needed because of the demand. I feel quite strongly, and this is a personal a personal feeling. I think there was huge amounts of duplicate demand over COVID. I don't think people were ordering what was needed. I think people were ordering way more, and that's not because the retailer was unrealistic about what he wanted. It's because the retailer was asking for the same thing from 5 different people.
I think we may have done this. I may have told this story, but I'm going to tell it again. It's like the retailer in Milan that calls up Castelli, says, "Hey, I need black bib shorts." He's like, "We're out." Okay, well, order me 50. Then they call Assos, "Hey, I need black bib shorts." Well, we're out. Okay, order me 50. Maybe he only needed 50. Yeah. But he ordered it from Castelli, Assos,
3 different people.
Whomever he could find. So
And that dealer might not have even ordered it. He just called 5 people and asked for 50 bib shorts. They're writing it down as demand. It's not an order, but it's a demand, right? So I think one of the biggest issues was duplicate demand being recorded, whether it was as orders or just interest in orders. I think, and the same thing happened with retailers. A customer walks in looking for something. Sorry, I'm sold out. He walks to the next store. Do you have it sold out? The dealer's still recording that as interest and demand for a product. Like, I think the order book far outstripped the reality of it. Anyway, that's the first point.
It goes back to the lack of sophistication of cycling.
Yeah.
The supply chain.
Correct. Speaking to the big players, I actually think they were far more calculated in what they ordered. But I do think a lot of them took on debt. And once again, I am not an expert in the Signa group and what went on behind the scenes, but it seems to me they took on a lot of debt in terms of acquisitions.
Okay.
So through that period, they were buying a lot of fascias on the understanding that all of these outdoor sports and categories were booming.
Well, they wouldn't to grow. Outdoor and urbanization and everything, these things didn't stop. Like this macro trend of the growth of cycling and the growth of outdoor and people's health consciousness and sustainability, this is continuing.
Yes. So once again, I'm speaking without having authority on the subject, but my understanding is they took on a lot of debt through acquisition of buying various fascias, and now that it's cooled, when you take on debt, there's obviously interest involved. There's terms and conditions around repaying that debt, and
there's a certain amount of margin that you have to sustain to be able to pay that off in a regular
Exactly.
And so it may have all just over leveraged. But again, let's just talk about kind of what we know. I think in my opinion, Wiggle has too many brands.
I think, to be fair to them, I think they were actively pursuing rationalization for some time now, right? Like I don't think it was a free market. My understanding is that they were going through brand and SKU rationalization for quite a long time
to reduce, kind of focus a bit more. Okay,
sure, yeah. I mean, a lot of businesses have been doing that in recent years. Certainly, as the reality of post-pandemic started to crystallize, anyway, SKU rationalization is a hot topic anywhere in the industry. Yes, they had a lot of brands that but I mean they weren't the only one, right? I mean, you look at any of the major e-commerce platforms across Europe, and they're brimming with brand offering.
Wiggle, I've heard that there's a bit consignment happening, but and again we're speculating here, but it sounds like there wasn't a ton of consignment happening at Wiggle.
I can't speak to that with authority. I don't know what brands would commercial agreements were with those guys. To be honest,
that's a whole other topic.
Once again,
but
yeah, if a brand was working on consignment with them, interesting as to what happens now to your inventory, right? Like who owns it?
Well, no, but consignment implies that the brand owns it.
Well, if it's in their warehouse now, who's going to open the door for you and get it out?
No, I'm sorry. I used the wrong word. Not consignment. What is it when you sell it after it's you make it available on your site?
Oh, like drop ship?
Yeah, I don't know how much drop shipping they were doing. Yeah. I know some brands do drop shipping, but that's an incredibly complex, and you really do. The service kind of decreases pretty fast if you're doing a lot of drop shipping.
Yeah. I mean, drop ship is pretty common, right? Once again, if you ask me to pick a major online retailer that leverages dropship, Wiggle would probably be pretty low down the list.
They did it last.
They're a business. Yeah, they're a business that historically would forward order, back those orders up, and take that stock in and sell it.
Because I know there are other ones that do dropship.
Oh yeah,
In Europe.
for sure. Yes, definitely. And you know, I think it's an interesting model. I certainly, yeah, I could go off on a tangent on that one. I'll keep this one
Let's
on
stay
target.
Yeah. So now, okay, so now WiggleCRC is in insolvency. They're probably going to have an administrator. So at this point, typically in these types of situations, the administrator will kind of make some decisions to come to kind of through. I think it goes through like I said, the administration. There's probably some, as you talked about, there are some talks about potential buyers, but they'll have to kind of unwind all of this, the assets and everything like that, for that to be then, and we'll see that in the next few days, or in the next few weeks. I just hope that that we're seeing the bottom here, because I mean, this is by far the biggest one out there. Again, like we talked about, there are very likely some leverage and the changes in interest rates and the cost of debt that have brought about probably the pressure that Wiggle and that Signa is feeling. These macroeconomic changes.
I don't think this is the bottom, unfortunately. I mean, I'm not saying that there'll be as many sort of seismic, changes to the landscape, but like I said, you look at the state of the market, you look at the inventory that's still in the market,
Sure.
You look at the value and volume of the orders that are currently coming in. It feels like we're a long way out from turning a corner.
Because of the inherent, like, you can't just eat this stuff. Like, you have to sell it, and by selling it, I guess to give people an idea of how that works, like, by selling it at a discount, you're also suppressing future demand, because people don't need, it's not like these aren't consumables. Like, these are things that you do use for some period of time.
And also, I mean, at some point, lowering the price does not increase demand.
No,
right?
That's the only.
At some point, everybody
have, right?
But at some point, everyone's bought what they need. And the run rate, depending on the category we're talking about, the run rate is what it is now. And lowering the price will only reduce the amount of margin that people in the food chain make. The lower the margin, the more expensive your overhead becomes effectively, and the deeper the hole becomes. So it's really a tragic situation, and I think there are some people, ironically, and I think this is the piece for me which is quite frustrating. There are some people out there running good businesses, doing the right thing, but because they're over leveraged or because they simply bought too much stock, probably will struggle to make it through this. Not because they're making bad management decisions. It's just that the math doesn't stack up based on where they stand today. So,
but one more thing though that I wanted to dive into is, like, the overproduction and the surplus demand is in specific categories. Mm-hmm. True statement or not?
Yeah. Well. I 100% agree that it affects some categories more than others.
Like,
yes,
for example,
sure.
Kids bikes, beginner helmets, beginner bikes, entry level bikes. Just that demand, where the demand, at least from what I'm seeing, is the demand spiked in certain categories, whereas, like, for enthusiasts, like really higher end equipment, that demand was pretty constant. Maybe there was a little bit of a jump, but it did come back. And I understand that the cash flow affects everybody. I get it.
Yeah. Well, yes, that's 100% accurate. But at the same time, look at the exposure. Like, if you're sitting on 29,000 euro road bikes or 100 euro kids bikes, like, at the end of the day, it's still a lot of money, right? And yeah,
but the likelihood that you're sitting on those 9,000 euro road bikes is much lower.
I think theoretically that makes sense. I think if you speak to dealers with those bikes on their floor, I don't know, right? Like, I think it depends on who you are as a dealer and how engaged your customer base is, and are you still getting those weekly group rides out and selling product on the bike? Like, I don't know.
Sure.
I think it's a tough time to be in the industry right now, especially if you're committed to a lot of stock over the pandemic. Like, it's tough.
Regardless, no, I know.
Yeah.
So anyway, we're gonna continue to watch this situation, John. Thank you for coming on. Is there anything else you wanted to dive into?
Yeah, I mean, I think it's a tough time for everyone right now. I think there are some positives, if I can be so bold as to say that. People are still riding bikes, right? I think if you get out there,
I'm hearing that across the board, that like maintenance and repair, that type of business is booming because there's just more people riding bikes by far.
Yeah. And I think, there's always, ultimately we are here to get people onto bikes.
Have fun.
And those people are out there and they're riding. I think there are people who are living with the legacy of the pandemic. They're living with the legacy of their funding structures. They're living with the legacy of the inventory they hold. Exactly. Like, it's going to be tough, and I don't think this is the end of it. But, I think it's easy to get really desperate about the state of cycling. And at the end of the day, if you get out there on your bike, people are riding, people still smiling. There is light at the end of the tunnel. We've just got to work through this bottleneck, basically.
Absolutely. And we are rooting for everyone. We're doing our best to kind of, shore up and get through it. But yeah, thank you, John, for coming on. We'll keep everyone posted on this. I've been writing about it every other week. Not necessarily always about this, but I write. And so we're kind of keeping some updates about this kind of developing situation. So thank you, John. It was great talking to you as always.
Sure. Thank you. Always. No, great one. Speak to you soon, Wyatt. Take it easy.